Good morning, everybody. Lee Lowell here, smartoptionseller.com. Welcome to another edition of the Saturday Synopsis. This is where I like to go over the charts, take a look at the market, see what it's done over the past week, and give some insight into where I think the market may be headed in the upcoming week. We always take a look at the three main indexes, and I also like to give out some free options information. We are an options trading company. I get questions from people on how to trade options. So this week we'll talk about bullish strategy. People say, Lee, I'm bullish. Should I buy stock or should I buy call options? So we will discuss that as well. I also like to keep these videos to 15 minutes or less if possible because I know everyone's busy. I don't want to take up a lot of your time. So let's take a look at the charts, see what we've seen over the last week. We always start with the SPY, which is the exchange traded fund that tracks the S&P 500, which is a great barometer of the market as a whole. As we've been saying, we've always been looking at the down move for the coronavirus and the V-shaped snapback rally. The market had popped up this week above this resistance line that I had drawn. First couple days of the week looking good, popped up above it, and then boom, Thursday, Friday, we had this big pullback in the market. Came back down below the resistance line. The ranges have been getting smaller. I've been talking about this as well. In the summer, we've got summer slowdown. So the ranges are not that big. They're a small range here. But the market rallied good early in the week and came back below. We've got the 20-day moving average here, which should be the first line of defense to contain any other pullback. Q2 earnings are still coming out. Been pretty decent so far. So if the earnings for next week are good, we got some biggies coming out. The market should rally back up. If the earnings are so-so, we'll probably meander a little bit. And if the earnings are pretty bad, we may start to drop off here. We've got the 50-day moving average, which should be the next secondary line of defense if it gets through the 20-day moving average. So we'll see. We've got, coronavirus cases still ticking up here in the U.S., which is not that great. We don't like to hear that. But at the same time, the U.S. government is also looking to institute another stimulus package. So that should keep some support under the market as well. Let's take a look at the NASDAQ, which has been the strongest of the three main indexes that we track. Look at this beautiful rally up here. Been tracking on the 20-day moving average the whole time. Thursday and Friday, big pullback. Came down below the 20-day moving average, but finished sort of near the high of the day, which is a good thing. The NASDAQ's really been pulled up by just a handful of stocks. These are the FANG stocks. We got Facebook, Apple, Amazon, Netflix, Google. Let's take a look. Apple, great company, had a big pullback Thursday and Friday. If you're looking to get into Apple, this could be your opportunity right here. Nice pullback. Probably 50-day moving average is the line in the sand for the next pullback. Could offer some support there. Apple's got some earnings coming up this week as well. Let's take a look at Netflix, another darling for the stay-at-home companies during the pandemic. Had this huge rally up here. Then earnings came out. People didn't like it so much, so has had a nice pullback. Looking 50-day moving average, probably the next line of defense there. What else we got? Amazon, another huge mover. Big up move. Came down to support, rallied up again, and now Thursday and Friday had the pullback as well. So we've got these few handful of stocks that are leading or driving the whole market. So NASDAQ, let's go back to the NASDAQ itself. NASDAQ got support right here at the 20-day moving average. Like to see good earnings this week to have the market pop back up again. Let's look at the Dow Jones Industrial Average. Has been the laggard of the three main indexes. It finally got through the 200-day moving average that we had been talking about last week. So it popped up above it, still above the 200-day moving average, which is good. The 50-day here and the 20-day are sloping upwards, which is what we like to see in an uptrending market. RSI indicator down here, which is an overbought, oversold indicator, right smack in the middle, which is good. So it's not indicating overbought or oversold. So Dow Jones is doing well. Had a little bit of pullback on Thursday and Friday as well. Not as extreme as the NASDAQ, but still above all the three moving averages that I track, 200-day, 20-day, and 50-day, which is good. So let's take a look at the SPY one more time, see what we think for the upcoming week. Like I said, 20-day moving average, 50-day moving average should be lines of defense for any other pullback. It all depends on earnings this week, or it could just meander around here. So we'll see. The ranges are small during the summer. Market is still strong. You know, until something really turns things around, we have to go with what the market is showing us, and that's to the upside. Now we've got U.S.-China relations having another little tiff this week. Don't know if that'll have a big effect on the market, but like I said, the U.S. government is there to backstop things, so they've got support under the market. So stay with the trend. The trend is still upwards. So if you're bullish, stick with the bullish strategies. Now let's move on to the options trading strategies that we want to talk about today. Oh, actually, one other thing. Let's take a look at the VIX. We always take a look at the VIX, which is the volatility indicator. Let's take a look at this before we move into the option strategy. VIX rallied strongly when the market sold off. And when the market rallied back up, VIX comes back off. The VIX, which is a volatility and fear indicator, moves inversely to the market in general. I've been talking about the 200-day moving average on the VIX. It came down below it, and then at the end of the week, it popped back above it, but it closed. A little tick on the right side of the bar here is where it closed for the day. So it still closed below the 200-day moving average. Now, if the market keeps going up, the VIX will keep going back down. As options trading goes, the VIX can tell you, VIX or the volatility has a direct influence on the prices of options. So as volatility comes down, option prices get cheaper. That's good for option buying. That's one of the things we will talk about today. So the VIX really has come down hard, still hovering around its 200-day moving average. So we'll see what happens in the week ahead. So let's talk about options trading today. People have been asking me, Lee, I am bullish. So do I want to buy stocks or do I want to buy call options? I'm not sure what to do. Well, I made up a little chart here, a little spreadsheet that compares call option buying versus buying stock. Now, the one thing you need to understand is when you buy call options, you have to have a gauge of how bullish you actually are on the stock and how far do you think it can move, because that's a big deal. All options have an expiration date. So if the stock doesn't make the move within the time allotted, you may end up losing all the money you put into the option purchase. So you really have to have an understanding of how bullish you are and how far you think the stock can move. One of the things we talked about in the past is using a probability calculator. Probability calculator, which you can get on our website, can tell you what are the chances of a stock moving from point A to point B in the time allotted. So you always want to check a probability calculator. But let's go over a sample scenario here. We've got a stock that is at $100 a share, and we're comparing three different types of call options: a deep in the money call option, an at the money call option, and an out of the money call option. So we've got a $75 call, which costs $26 per contract. We've got a $100 at the money call, which costs $5 per contract, and an out of the money 125 strike call option for 50 cents a contract. And it's 3-month expiration, and the stock is currently at $100 per share. So in the columns here, we see the various stock prices here. We've got the stock and the dollar amounts it can make or lose, and the stock percentage amounts it will make or lose, and the 75 call, the 100 call, and the 125 call, the dollar amounts and the percentage amounts. And we can compare all three of those versus the stock at various stock prices. Now, obviously, if you buy the stock at $100 a share, that will be your break even. When I talk about call option buying, the only strategy that I really like to talk about and use is buying deep in the money call options. And I've talked about that before, written about it before in the blog, on the website. And if you go back to my YouTube video from April 18th, I talk about deep in the money and why it's a superior way to buy a call option. So if you want some more information, go back and take a look at the April 18th. I believe it's April 18th YouTube video. So the 75 call option has its break-even price at $101, and the stock break-even price is obviously $100. So the 75 call and the stock itself have break-even prices that are very close to each other. So you'll see that the dollar amounts that are gained on the upside are very in tune with each other, very similar. But the percentages, obviously, for the call is almost 4 times as much as the percentage return on the stock itself. Now on the downside, the great thing about buying call options is you can't lose any more than whatever you paid for the option itself. So even though you may lose 100% of your investment, it will always be a lot less dollar-wise compared to the stock. So that's a great thing for buying call options. You have a lot less to lose dollar-wise. Now the $100 call, the max you can lose is $500, and obviously with the 125 call, the maximum you can lose is $50. Even though it's still under 100% loss, it's still a lot less than the dollar amount you can lose for the stock. On the upside, like I said, the 75 call and the stock itself have very close break-even points. The $100 call break-even is $105 a share right here, and then you can see the dollar gains. Not as much as the stock or the $75 call, but now you're really starting to talk about percentage gains are really ticking up here. Your 125 out of the money call option, a 4,900% return. That's if the stock gets up to $150 a share. So you can see the numbers here at the bottom, compare them all. Obviously, if the stock really skyrockets, the out of the money $125 call option is really going to give you the most bang for your buck on a percentage return. The dollar amounts are always going to be about half of what, in this case, half of what the stock can move, what the stock can make. But you have to think, what are the chances of the stock going from 100 all the way up to 150 in 3 months? That's a huge move, $50 move in 3 months. Not a lot of stocks could do that. I know you like the numbers here, it looks good, but you have to remember, what are the chances of the stock moving $50 a share in 3 months? Check the probability calculator. You're going to find that your chances are very, very slim. So that's why I like to stick with the $75 call option. Break-even price is only $1 higher than the stock break-even price. And you're going to make just as much, almost as much on a dollar basis that as the stock does, and your returns are going to be a lot higher. The at-the-money call, it's not a bad choice either, as long as the stock starts to move, right? Just to break even, the stock has to go from $100 to $105 a share. I think most stocks could probably do that. 3-month time frame. Check the probability calculator. So there you go. You've got your comparisons here. The biggest thing is that you have to have a gauge of how far you think the stock can move in the time allotted. If you're really, really, really bullish on the stock, hey, take a chance on the $125 call. It only costs $50. You could really make a lot. But I like to stick with the deep in the money call because I like to have my break-even price very close to the current price of the stock. Yeah, it's going to cost you more, cost $2,600 to buy that call. It's still a hell of a lot less than buying 100 shares of the stock. So that's all for the lesson today. Different strike prices versus buying the stock. Let's talk about the website. Now, if you haven't gotten my deep in the money, if you haven't got my Put Selling Basics ebook yet, free on our site, go to our site, download the Put Selling Basics ebook. That's what we like to talk about. We like to sell options. We sell put options. And also, services tab. Once again, you could look at our 2 newsletters and our one-on-one coaching. If you want a little bit even more information on a deep in the money strategy, click on the shop here tab right here. I've written a 3-year study on a deep in the money call option strategy. It might be of interest to you. So there you go. That's all for me today. I hope everyone has a great weekend and a great trading week ahead. This is Lee Lowell signing off.